I see some folks have joined. We'll give it just another minute or two before we get going. Allow time for everybody to jump on.
Sounds good.
All right. Well, it is 12:03, so we can go ahead and kick things off. Good afternoon, everyone, and welcome to our Q3 Individual Equity Stock Portfolios Update webinar with Steve Galley, our Chief Investment Officer. Thank you for joining us today. We welcome your questions and we want this webinar to be as interactive as possible. So please feel free to submit your questions to us through the Q&A or the chat feature at the end, and we will get to as many of those as possible. So with that, I will turn it over to Steve to get us going.
Thank you very much, Anna, our fabulous marketing partner from Avantax, and thank you all for joining us today. Hopefully we'll make this fun and informative, and just got to get some disclosures out of the way. And what are we going to cover today? Well, as usual, we talk about what's happening in the financial markets, and then what that means for our viewpoint on investments. And today I'm also going to dig into the details behind the scenes in terms of, how do we really pick and manage the investments we choose for portfolios. And then I'm going to also discuss some of the changes that we've made as a result of current market dynamics. So I also want to mention that, what we've tried to do in this particular webinar is, because we do these webinars basically twice a quarter, but if you've been invited to this webinar or it means that you are invested with us, and it means you are invested in one of our stock portfolios. It means you own individual stocks based upon a portfolio that we have designed for you. It also could mean that you were interested in us managing a individual equity or stock portfolio for you. And so this webinar is designed for those clients who do have those types of portfolios. And that's why we get into more details about what we're thinking about specific stocks. So with that, I always think it's interesting to look at the current headlines that we're seeing today. This one was from this weekend's Barron's. And this is sort of the whole idea that, where are the bears? Because when you don't have the naysayers talking about how expensive the market is, that's when you should get nervous, when everyone thinks everything is great. So I think that's always a fun headline to see, and maybe a dangerous one. So this is recently from the Wall Street Journal, that the stock market rally has stalled despite the earnings season actually being pretty good. And this refers to the fact that really August has not been that great so far for the market after a really great run through the end of July. And we'll talk about that. This is a recent one from Bloomberg, the other day, talking about how the Federal Reserve, or the Fed, is trying to avoid a recession by playing a waiting game, meaning, do they need to raise rates again, or can they hold where they are? And will that be enough to conquer inflation, which is really what the Fed has been trying to do for the last year plus. So all interesting headlines, and we'll kind of address what's happening behind them as we get into more details. But also, I always like to share some interesting facts that we observe as advisors that we think is important to put out there. And this I thought was an interesting statistic put out by Charles Schwab, that the average American, and how you define the average American is probably an interesting study to do. But the average American says they will need to save almost $2 million for retirement, which is basically $1.8 million which is up 6% from last year's 1.7 million. But I think more worryingly, only about 37% of those surveyed think they are very likely to achieve that target goal. And that's actually way down from 47% a year ago. And I think that has a lot to do with the concerns about inflation and things getting a lot more expensive in the market today. So, you know, something to keep in mind, you know, maybe retirement is actually not as assured thing for many people out there, which is all the more reason you need to make sure that you've got someone making sure that your investments are doing what they're supposed to be doing. Another stat, you know, people talk about, you know, how the market's been so good in the first half of this year. Well, doesn't that mean it might not be so good for the rest of the year? So I think this is interesting. So since 1928, or really since most of this data was being recorded, the S&P 500 has averaged a gain of 2.3% from the end of July through the rest of the year. And it's basically been positive 71% of the time. But I think more importantly, in the 32 years where the index was up over 10% in the first 7 months of the year, which by the way, it was this year, it was up, you know, basically close to 18% through the first 7 months of this year. The S&P 500's average performance for the rest of the year was a gain of 6%. So really healthy and positive returns overall 91% of the time. So sometimes, you know, for those who believe in momentum investing, sometimes good momentum keeps going. And I think that's sometimes what these stats tell us, that just because it's been good for the first half of the year doesn't mean it won't be good for the next half of the year. And, you know, what's some of the reasons behind that? Well, actually, I think this is interesting. Some of the reasons behind, I think, the surprise this year is that US worker productivity surged by almost 4% last quarter, in the second quarter. That was the largest productivity gain since 2020. And, you know, I think that's important. And I think a lot of that may actually have to do with some of the impact that the artificial intelligence revolution is having on certain industries in terms of making people more productive at what they do by leveraging AI. So if this trend continues, I think that could be really good news for company earnings. And by the way, what a great year it's been so far. This is actually through a day or two ago. And I've sorted this by the market return year to date on some of these indices, which represent certain segments of the market. So it's been all about tech, all about growth, right? So the NASDAQ index, the NASDAQ 100, which is very technology oriented, up 38% year to date. That's pretty staggering. I don't think anyone expected that. Here's the S&P right here, up about 17% year to date, and that's through the other day. Not so great when you talk about value stocks, right? And value stocks tend to be more conservative, dividend oriented. So if you look at the value index, or the Russell 1000 value, that's only up about 5.5% this year, versus the growth, which is up over 28% this year. Big differences, right? And this is why I think diversification matters. You don't want to have all your eggs in one basket. You need to spread things around. So, and obviously leading the bottom here is the bond market, which, because rates have risen a bit this year, bonds have struggled a bit, right? So that's one of the reasons why you see kind of, you know, average returns from bonds. Although if you annualize these numbers, they're not too bad. But we'll talk a little bit more about the bond market on the next on another slide. So one of the people who, you know, a lot of times we get questions like, what happened to the recession? You know, I thought the Fed was going to have to cut rates. And, you know, I think the reason that we haven't seen a recession is usually recessions are started by, you know, kind of one of three things, right? If businesses make less money or less profits because of some shock to a certain sector or industry, well, that tends to mean that they lay off people. And if they lay off people, then people don't have as much spending power. And then of course, if there's not as much spending, the economy goes into a recession. None of those things have happened, right? The labor market is strong. businesses' profits are actually surprising on the upside. So, people aren't really expecting rate cuts, but let's see what Goldman Sachs has to say about this. They actually published this research about 4 days ago, and it says that their forecast calls for the Federal Open Market Committee, or basically the Fed, to start cutting rates in the second quarter of next year, right? Not this year, but the second quarter of next year. And why? Well, that's because they believe that at that point in time, inflation will have fallen below a 3% year over year rate, which would give the Federal Reserve the ability to say, okay, we've slayed this monster of inflation. It is no longer, above 3%. We're comfortable that it's below 3%. And now we can actually start cutting rates, because right now where rates are, it should be slowing the economy down. And it hasn't quite happened yet. And that's what that headline was referring to. The Fed is waiting for the impact of their rate rise, their rise in rates that they put into the economy to slow the economy down. It hasn't quite happened yet because the economic results have actually been pretty good. So really, what does that mean for the market? What does that mean in terms of looking at investments? So where were we about a year ago? So everyone knows I love looking at this chart. This really is a chart of the forward price earnings ratio of the S&P 500. So this shows for the last 25 years, what have you had to pay for earnings for the S&P 500 companies? And as you can see, on average, you have to pay between 16 and 17 times earnings to invest in the market, right? On average, that's how much you have to pay. For every dollar of earnings, you need to pay $16 or $17 for that dollar of earnings. Well, as you can see, a year ago, basically at the end of July of 2022, we were right around the long-term or 25-year average, meaning the market really wasn't that expensive. It wasn't cheap, but it wasn't expensive. It was right around the average. So you could have made an argument about a year ago, maybe that wasn't such a bad time to buy, because you could feel comfortable that you weren't overpaying, at least based upon a forward price to earnings measure, which I think is a fair indicator of whether stocks are expensive or not. But where are we now? So this is as of August 15th, a couple of days ago. Well, we're no longer near that long run average. We're actually pretty well above it. As a matter of fact, and this you can actually see, it's hard to notice, but recently this has come down a bit where this green dot is. But at the end of July, we were actually getting close to what we consider to be pretty expensive territory in the market, meaning you were paying over $20 times for every dollar of earnings on average. And that's when things get expensive. And the only time it was that expensive in the past was after the pandemic boom, after we came out of the pandemic, and then up here back in the late 90s, early 2000s, that was during the dot-com bubble. So we rarely get above that 20 times forward PE ratio. That's rare territory. So that's why we get a little nervous whenever we start approaching that line. So as I mentioned, it's been a great start to the year, especially for technology companies. So if you look, and this is through the end of July, where the S&P was up about 20%, but infotech as a sector was up way more than double that. So great time to be invested in tech. Everyone knows I love technology as a sector, but you got to be careful, right? Because as much as it can go up fast, it can also go down fast. So I think this is interesting. If you look at the best starts to a year for the technology sector, these are the top 10 periods we've seen for the tech stock performance since 1990. And basically this year, it's been one of the best. And what does that mean for the next 5 months? Well, obviously we don't know, because 2023 still has to play out. But I think what's good to know is that on average, the next 5 months usually have been pretty good. And again, this is part of it. Sometimes that momentum still carries through for a while before the market gets nervous about valuations. And that certainly has been the case a majority of the time. Not every time, but a majority of the time. So that should give us some comfort that just because it's been a great start for tech doesn't mean it's not going to be a great finish for tech, at least this year. And now what about bonds, right? Do we need to be worried about bonds since, it looks like, inflation is still kind of lingering around and the Fed maybe has to keep raising rates? Well, I would say right now, probably not. I think a lot of people believe that the Federal Reserve is done raising rates. And, once you get a Fed funds rate, which is now, 5+%, as long as that rate is above inflation, that usually is a good thing for bonds. And right now, that's the case. And usually bonds do perform well when that Fed fund rate stays above inflation, especially for a certain period of time. And so you can see that the bars here represent the average returns when the Fed funds rate was greater than inflation since 1955. So whether you're in like core intermediate bonds or short-term bonds, even in short-term money market funds, which is very, very short maturity, usually 3 months or less, the returns are pretty good on an average annual basis, right? And why is that? Well, that's because usually the Fed doesn't like that rate to be too much higher than inflation. So that usually means the Fed has to cut rates. And what does that mean? When rates come down, what happened to bond prices? They go up. And so that's one of the reasons why you see pretty healthy numbers for bonds when the Fed funds rate is greater than inflation, because usually that means at some point the Fed will cut. And as our illustrious colleagues at Goldman Sachs have informed us, they think that might happen next year. Okay, so now I want to dig a little bit into our process, just so that people are aware of what kind of goes on behind the scenes in terms of how are we picking your investments? What's the process, and are we disciplined about it? So we do have an investment committee that meets 8 times a year. And every time we meet, we review and debate, and we have very healthy debates about not just the overall asset allocation. And by the way, that's for every certain risk category, because obviously certain allocations are more appropriate for certain clients who can take more risk versus ones who don't want to take risk. And we also evaluate all the individual investments that execute on those asset allocations. And so in general, we have an investment committee that is, a lot of CPAs, and those are our accounting partners and tax partners who really are the backbone of the organization, as many of you know, who we also do your taxes for, because we believe those 2 disciplines should be very intertwined. And we also have 12 advisors on the team who also are part of the investment committee, who have continual input into what we're doing in regards to allocations and investments. And then I also want to mention that in general, we always have what I would call a bit of a conservative bias, and especially that I think that comes from, sort of our accounting backgrounds for many of us, in that, we feel more comfortable with investments that we understand, that have a proven track record, and that are a bit more predictable in terms of having more steady cash flows and having strong balance sheets. And that's really, what the investment committee looks like. And, I kind of, I was an English major in college, so, I did a lot of British literature reading, and I loved the Arthurian legends. So, an analogy I'll put is, it's kind of like a round table, right? And why was the round table so famous? Well, it was famous because, the message was that no one is above anyone else. Everyone has an equal say at this table. We want to encourage healthy debate. And so that is what we do in the investment committee. We want to make sure that everyone's included and everyone has a say in what happens with the investments. Now, that being said, of course, there are managers on the investment committee to organize and steer the process and help facilitate the decision. So there are 3 of us, Charles, who many of you may know, who's doing a great job. Also Bio, who's also doing a great job. Both of them are CPAs. And then, of course, myself, as the chief investment officer, are also one of the managers for the committee. And we really, I love to say it's all about the team and making sure that we have healthy debates, are always checking each other on our potential biases on certain investments, and making sure that what we're picking is the right thing for our clients each and every quarter. So, by the way, there's a lot of letters and numbers sometimes around people's names and, their designations and qualifications. So I thought I'd just go through that real quick because, a lot of our team are CFPs. So in case anyone's not familiar with a CFP, it is a pretty well-known designation in the investment industry. And I just went to the Investopedia website and pulled off their definitions of CFP. So Investopedia seems to think that becoming a CFP is quite difficult and it requires years of experience. And the most important aspect of the CFP is that they have a fiduciary duty, which means we must make decisions with our clients' best interests in mind. And this is, quite frankly, to me, why I think a CFP is kind of a must-have designation for your advisor, because it means that they have a fiduciary duty towards you and they want to make sure that they're keeping your best interests in mind. Obviously, a lot of our team are also CPAs. So I put up, a few factoids about CPAs, but obviously accountants have to, go through a lot of training to become a CPA. It's not easy. And then, of course, it means that they're capable of digging into the details of any company's balance sheet to understand what's going on, which I think is really important when you're doing investment research. Also, and I'm gonna highlight Bio here. Bio recently passed his CFA Level 3 exam. And that's fantastic because the CFA is a pretty hard designation to get. He's still working towards it because just because you passed your exams doesn't mean you automatically become a CFA, but he's well on his way there. And I thought I'd highlight the fact, and this is also from Investopedia, that only 11% of people make it through all three levels for all the ones who take it. And so I think that's really impressive. And in the last 10 years, apparently the completion rate was actually below 10%. So great job, Bio, on the pass. I think that's fantastic. And once again, I think, it's really important to make sure that we have really smart people who really know what they're doing behind you on our investment team. And I think this is a nice summary from Investopedia that the CFA charter is one of the most respected designations in finance and is widely considered to be the gold standard in the field of investment analysis. Great, thank you, Investopedia. Hopefully everyone feels pretty good about having a CFA on the team. Oh, and by the way, a CPWA is also on the team. That happens to be me. What is that? Well, it's really good in terms of managing it's a designation, meaning that you generally are comfortable understanding what some people who are high net worth or have a substantial amount of assets, some of the intricacies that they're involved with, and some of the things that you need to take into consideration when you're trying to protect their assets and transferring wealth to the next generation. That's the CPWA. In addition, I should also mention, there's also an MBA in finance on the team. So I got my master's in finance from the Stern School of Business, NYU. I actually just checked the other day that Stern is now ranked #3 in terms of the best business schools for getting your MBA. So I'm happy to see that my alma mater is maintaining their prestigious reputation. So I do want to make sure that everyone feels comfortable that there's a lot of effort going on behind the scenes on the investment team. I think a lot of intellectual firepower, and I think that's important. And I think usually, at least in my experience on advisory firms, it's rare that you have that type of education and experience behind your investment team. And I would challenge anyone else to find a better team than that out there. So I'm really happy about the team. And of course, it's not just the team, but it's also the process. So what is part of the process that we follow when we're picking stocks in particular? So we use a lot of different research services. One, of course, that I've mentioned before is Morningstar. And Morningstar is best known for rating funds. But so what we actually leverage Morningstar, which we think is really interesting, is we have created lists of what we think are the best portfolio managers for their respective categories. So what I pulled up here is an example of the fact that we have, and we call this our smart PM factor or smart portfolio manager factor, meaning we have created lists of funds in each category, whether it's large cap, mid cap, small cap, growth, value, foreign, of managers who have consistently done really well over long periods of time, which means those managers are doing something right. And they themselves have a good system and process for doing that. And so we track the stocks that all those managers seem to like the most. And so that's one of the ways that we have a quick way of figuring out what are the stocks that we should be looking at, because we look at what the smart portfolio managers are looking at. We also make sure that we, do a lot of research. Like Barron's quite frequently highlights certain fund managers that have a unique angle or a great track record because they have a special process. So we always, we're always paying attention to that too, which will supplement our smart portfolio manager lists. And then that helps us come up with our own conviction list of what are the stocks that we think are worth owning. So as I mentioned, we leverage Morningstar, but what else do we leverage? I've talked about this before, but we love Value Line Research. And why do we think Value Line is a great research service? Well, it's been around a long, long time. It's one of the nation's largest independent research services. They cover almost every stock. They have over 70 analysts who are looking at stocks and writing reports. They've been doing it for over 90 years. Great service, and we leverage that research. But don't just take my word for it that Value Line is good, because I thought it was interesting to highlight the fact that when I was actually studying for the CFP, and this was several years ago, but I actually keep all my textbooks because I used to write notes diligently and stuff like that. So this is the textbook that was used when I took the CFP and I had to study for it. And you can see this the cover of this happy guy studying for his CFP. But what I actually noticed on one of the sections, and this is in chapter 12 on page 512, it was getting into the efficient market hypothesis. And what is the efficient market hypothesis? The efficient market hypothesis says that all the information about stocks is the market digests it immediately. So in other words, if Amazon is trading at $200 today, the efficient market hype theory says that's exactly what Amazon is worth, because all the information that can be known about Amazon is incorporated into that market price today. Meaning, the only reason I would think Amazon is more expensive, should be less or more, is because I know something the market doesn't. And basically, this hypothesis says that's almost impossible. However, this particular part of the textbook did note that there are anomalies, meaning there are some things that maybe make that hypothesis about the market being perfectly efficient not so true 100% of the time. And so then I got into more detail on that, and this is a highlight saying, and this is in the same chapter, saying they cited the Value Line enigma. What is that? Well, it actually says that stocks that are rated 1 on Value Line scale of 1 to 5, meaning 1 being the highest out of 5, 5 being the worst, have actually outperformed lower rated stocks. And that means that Value Line seems to have an ability to identify stocks that are worthy of investment. And why do I think that's important? Well, quite frankly, Value Line is based upon the Benjamin Graham School of Research, which is that if you don't understand it and don't have good visibility into future cash flows, how can you invest in something? And that's actually, Benjamin Graham is the same person that Warren Buffett is a disciple of. So that's one of the reasons why we like that research, and one of the reasons why we believe in it. We think it makes a lot of sense, and it helps you avoid what I would call big mistakes when you're picking stocks. So, I thought I'd digress a little bit on that. So besides Morningstar, besides Value Line, we also use another research service called BCA, or Bank Credit Analyst Research. And why do we use them? Well, they've been doing it since basically 1949. They're one of the largest independent providers of global investment research. So they're also good across the rest of the world, not just the US. And so we also really like their research. So again, we really want to make sure that we are spending a lot of our resources on making sure we have great data and information on the investments we're looking at. And so this all comes to fruition by combining what I would call the best of all those services to come up with our conviction list. And so, as you can imagine, what we do is we kind of do a cross section. And so I call it, kind of the trifecta, meaning if there are stocks that all 3 of those research services are really bullish on, then we feel pretty good about those stocks. And most likely those stocks are going to be prime candidates to be included in our individual equity portfolios. And so what are some of those conviction stocks right now? Well, probably no surprise, Microsoft, Apple, Google. I mean, the bottom line is, if you don't own those stocks and you're a portfolio manager, that can be problematic, right? Especially when stocks like that have driven a huge portion of the market gains this year. So obviously, that's one of the reasons why those stocks are in our portfolios, because not only are the research services convinced that they're good holdings, so are we. Another tech name that we've actually had in our portfolio a long time, which makes this trifecta conviction list, is Adobe. I've talked about Adobe in the past, but anytime you have a technology company that, in my opinion, almost has a monopoly on digital content creation, which Adobe has, sign me up for that, because that usually means great margins and great cash flow. But then, surprisingly, the other couple of trifecta stocks that appear on the list are Pepsi and Coke. Now, this is where the debates get interesting on the investment committee, because in general, when you invest in a stock, what are you doing? Well, you're a very tiny owner of that company, and you own that company because ideally you believe in it, and you believe that that company will make you money, right? So I have a certain bias against Pepsi and Coke, only because if your primary product is sugar water in many respects, that doesn't get me very excited about their business, right? Now, to be fair, Pepsi and Coke have many other business lines. It's not all about soda. I mean, there's snacks, there's water, and there's healthy water and electrolyte water. I mean, actually, I have a friend of mine who is the CFO of Pepsi, and Pepsi pays the family from that invented Gatorade, which they actually from the University of Miami, an incredible sum of money every year, because Gatorade is a Pepsi product, which is a great product for them. But so one of the questions we ask is, why are all the research services saying that stocks like this, which I personally am not that excited about, like Pepsi and Coke, why are they in the portfolios? Well, part of the reason is because they're defensive, right? Pepsi and Coke are considered consumer defensive stocks. What does that mean? It means that usually when things get a little dicey in the market, or the market gets volatile, the defensive stocks perform well. Defensive stocks tend to have low betas. And I think the last time I checked, I want to say Coke had a beta of about 0.75. What does that mean? Well, if the beta of the market overall is 1, and Coke's beta is 0.75, technically that should mean that if the market drops by 10%, Coke should only drop by 7.5%, because it's less volatile than the market, which, quite frankly, is the type of thing you want to be in if you are nervous about the future market returns. You'd like to be in things that will go down less than the overall market. So I think part of the message here is that if you are going to be holding a lot of technology companies, and by the way, Google isn't technically a technology company, it's actually a communication services company. And the reason we love Google is because of YouTube. And that's why Google is considered a communication services company, because that's where Google makes most of their money, is from YouTube. But anyway, if you're going to hold these, what I would call, more expensive tech or communication services name, a great way to offset some of that risk in your portfolio, to diversify, in other words, is to hold more defensive names. Hence the reason for some portfolios holding Pepsi and Coke. And then what's another trifecta name that comes up in our research? And this is not necessarily a household name, but maybe some of you have heard it, Novo Nordisk, the New York Stock Exchange tickers NVO. Who are they? Well, that is a big pharmaceutical company, not too dissimilar from the Pfizers and the Mercks of the world. But why is Novo Nordisk a big conviction stock? Well, part of it is because the reason Pepsi and Coke are doing so great is because Americans can't stop drinking sugary drinks. And when Americans can't stop drinking sugary drinks, what do? They put on weight. And who right now has probably the leading new weight loss drug on the market? Novo Nordisk. Not sure if anyone has heard of Wegovy. Wegovy is actually the term for the weight loss drug that Novo Nordisk is known for. And I recently actually just read a study the other day that said that it actually is really effective. And of course, even better for Novo, it's effective as long as the person keeps taking it. So if you think about it, that's a pretty sticky product, right? So obviously, that's another reason why that stock is on the conviction list, because of the potential future cash flows from a drug, which is obviously very, very important for the obesity epidemic that is continuing to sweep this nation. So I hope that was helpful in terms of explaining some of the process behind some of our conviction picks for stocks in the portfolio. By the way, the other thing we really care about, and I joke about a hot topic being benchmarks. A lot of people start yawning and falling asleep when we talk about benchmarks, but I do think it's important. And there are different benchmarks out there, right? So, if you think about S&P, S&P actually believes that only 1,500 stocks in the market matter. They carve it up by the 500, which is large cap, the next 400, which is mid cap, and then the next 600, which is small cap. So that's 1,500 total. And basically they say, well, that covers about 90% of the US market capitalization. And that's all that matters. I think that's a fair argument. And I think the S&P indices are actually quite good. But there's other benchmarks out there too that I think are sometimes even more simple and elegant. Russell is another provider I really think makes it very clear. Russell kind of looks at the stock world as either have big or small. So the Russell 1000 basically covers large and mid cap stocks. And then the Russell 2000 covers small cap stocks. And so Russell actually thinks that 3,000 stocks matter. So they cover 3,000 with their primary benchmarks, not just the 1,500 that S&P covers, right? And so we actually think that the simplicity and clarity of Russell, it makes for a good benchmark. And so when we make benchmarks for our individual equity portfolios, or we sometimes nickname them IE, and this is an example of the portfolio benchmarks that we use for those. And I've circled, for example, our 45 stock growth portfolio. The benchmark is pretty straightforward. It's 77.5% in the Russell 1000 and 22.5% in the MSCI All Country World Index ex-US, meaning basically the rest of the world, not including the US. And we think actually these are really good, tough benchmarks to beat. They're very hard to beat, and they're very appropriate for the portfolios we design. So, and how does that get into the analysis? Well, let's take a look. So I pulled up, this shows how our portfolio right now is allocated. This is the individual equity 45 growth portfolio compared to the benchmark. So you'll see the benchmark says we should have about 77% in the US and about 22.5 in non-US. And we're pretty close to that. We're 80 US and about 20 non-US. And we don't like to deviate too much from that, right? So if anything, we are shading a bit more US at the moment in that particular portfolio. But more importantly, also the sector diversification, because I've seen many, many portfolios, not managed by us, of course, that are overweight in certain sectors, like tech, for example. So we take care to make sure that we have an appropriate number of stocks representing each sector. So if the benchmark says we should have about 24%, or in this case, 23.96% in tech, we want to make sure we're pretty close to that. In this case, we are, because we have 24.5% in tech. Now, you'll notice the benchmark here says we should have about 6.6% in consumer defensive stocks, and we just talked a lot about Coke and Pepsi. We actually have 8.8 in consumer defensive. Why? Well, part of the reason is after such a great year we just had, and as we talked about what a great year it's been, we don't think it's such a bad idea to position the portfolio now as being a bit more defensive than the benchmark. So that is why we're okay shading more defensive versus the benchmark. And that's by design, and that's on purpose. And again, we think that's prudent after such a great year we had. So we really pay attention to the sector diversification. And last but not least, we also pay attention to, and in this case, are we properly diversified between large cap and mid cap stocks? So you'll see that the benchmark, and this is the benchmark box that I'm circling with the mouse right here, hopefully everyone can see that, they basically say you should have 18% in mid cap, and actually it delved into 2% small cap. And lo and behold, we have 20% in mid cap, which pretty much mirrors exactly what the benchmark says we should have in terms of cap size. Same thing for value and growth. The benchmark here says we should have about 38% in growth only. We have about 27%. Now, why is that important? That's important because we are shading a bit more defensive now. So we are a bit less growth oriented than the benchmark. Not necessarily overly favoring value. You'll see that value says 25% here, we're actually pure value of only 20. But on balance, we're relatively close. But again, that's because we believe that being a little more conservative, at least for the rest of this year, makes a lot of sense. So all these things go into the analysis of the portfolios. And that's why I do want to make sure that we spend a little bit of time talking about benchmarks, because in my opinion, benchmarks matter. Because if I say, hey, your portfolio did great, you were up 10%. Well, how does that compare to the benchmark? Because if the benchmark went up 20, then maybe that's not so great, right? So we do think these things are really important. So really, what is our promise to you as clients? Our promise is that we really are disciplined about this, because in all the studies I've ever read, the one thing that really matters in investing is discipline. As a matter of fact, when I was actually at NYU taking one of my first finance courses there, I had a professor that everyone thought was really great, and I couldn't wait to see what this guy had to say. And so he got up there and he said, I just want to cut to the chase here, and I want to tell you what really matters in this business, because every one of you always ask me, all you budding investment bankers, and I'm sick of the question. So I'm going to tell you right now what matters. He said, it's the 3 Ds: discipline, discipline, and discipline. And I never forgot that. I thought that was kind of funny. So anyway, that's our promise to you. We do really have a rigorous due diligence process. We make sure that we're very disciplined against our benchmark, and it's all about the team. It's all about making sure that we have healthy debates about what we're picking. As I mentioned before, we do have a bit of a conservative bias, right? We want to make sure that we're being really prudent with your hard-earned dollars. We also tend to really try and look for industry leaders that we think have competitive advantages that they can hold on to. So a good example is, like, for example, a cybersecurity company. There's a lot of cybersecurity companies, but one of the key portfolio holdings we own is Palo Alto Networks. Why? Because they're a leader in cybersecurity, and we think leadership begets leadership. So back in the day when IBM was an important stock in the 80s, and everyone said you never got fired for hiring IBM. Well, in today's cybersecurity world, you never get fired for hiring Palo Alto for your cybersecurity provider. So that's the type of things we try and pay attention to. And of course, we always have a quality bias. When we use that Value Line research service, we favor stocks that have what the Value Line scores as safety 1 out of 5, 1 being the best. What does that mean? It basically means, according to Value Line research, those stocks have the strongest balance sheets and the most predictable cash flows, and are the ones that really would be secure even given a bad market. So we do have that quality bias. In addition to that, we also are disciplined about how we rebalance, right? Because a lot of times stocks get ahead of themselves, and that can happen very quickly. So every quarter we rebalance. So in other words, what's happening as we speak is we are rebalancing a lot of the portfolios to make sure that some of those tech stocks that had a great run, we're taking a little bit off the table and reallocating maybe to areas that are a little not as expensive and have a little bit more room to run moving forward. So we always make sure that we're rebalancing. We communicate that to you on a regular basis. This is part of that process. We also have a very tax-aware mentality when we trade accounts. So even if we think, selling one stock and buying another one is the greatest thing for all clients, we actually, if we see any particular client that has an outsized gain, or a capital gain, I should say, as a result of that trade, we will not trade it. We will hold that trade until the advisor has a discussion with the client to make sure, hey, are you okay with us realizing a bunch of gains as a result of this trade? Because we don't want to, create unnecessary tax burdens for you. So we do have what I would call a tax screen on a lot of our trading. And by the way, I think that's super important. That's one of the ways that we ideally outperform other managers as well as our benchmark, because we provide tax alpha. We give you returns that also have a tax efficient manner in mind. And then, of course, we're flexible. A lot of our clients love to talk to us about their investments, what they're invested in, why. Some clients have very strong opinions and biases about certain investments. And so we're happy to discuss that with you and make adjustments if that's necessary. Unlike some other big shops who have a set portfolio and you either get that whether you like it or not, we're happy to make adjustments for you. And that's kind of our promise to you, and why, we're always about client first. We want to make sure that, whatever we're doing in terms of investments, you're okay with. So we do have that flexibility, which we think is important. All right, so I know I've been talking a mile a minute, and I feel bad about that. So I'm just going to quickly finish up to also mention, because I always try and spotlight some stocks, but sometimes I think it's important to look at what did we not invest in, right? What did we not invest in, and was that a bad decision? So one stock I like to talk about is Meta, better known as, or previously known as, Facebook, and also the proud owner of the Instagram franchise. Now, why do we not invest in Meta? Well, part of the reason is, and again, this is where it's very important to not let personal biases get involved, in that I actually think Meta is putting out a product that is more addictive than nicotine, especially for young kids. And so I do have a personal problem with their business model, right? And so, however, if this actually is a kind of an interesting chart, this shows the stock price of Meta over the last 2 years, right? So this is basically this time 2 years ago, Meta was up here. And in November of 2022, Meta was way down here. And that's when actually Meta started flashing a buy signal to us and some of our research services, but we didn't buy it. And so one of the reasons we didn't buy it is that, in addition to the fact that we also, don't have a tremendous liking for their business model, we also think there's actually a lot of political risk to Meta in terms of potentially legislation that could curtail some of their revenue generating ability. Again, because of the fact that I think studies keep coming out that their product can be very damaging to not just young people's brains, but also their social lives and their social health. So, I will say, do I wish I bought Meta down here? Probably. That would have been a good move. Sometimes we can't get everything right, and sometimes we have to make sure that we sometimes just focus on the numbers. But again, when we buy a stock, we're buying it and we're becoming owners of that stock. So you really want to believe in that company if you're going to be an owner of it. So, and this just shows where Meta is now. This actually shows the last 5 years. Meta is actually still not as high as it was during the pandemic. So, obviously we'll keep an eye on that. And obviously right now it's pretty expensive, so probably a little late to get in. But, again, it's good to understand some of the things we missed, and maybe we missed because of personal biases, to make sure that we don't do that again. By the way, just in case people are curious about what Value Line says about Meta, not a safety 1, only a safety 3. So again, one of the reasons why we're not that excited about Meta at this point, because it doesn't really have that rock solid safety ranking that we like to see. So just wanted to make sure we touched on that, because again, sometimes it's what you don't invest in that matters, as well as the lessons learned. Okay. So what does all that mean? Real quick, just to sum up, what happened to the recession we were supposed to have? Well, apparently that's really not much of a concern, but I do think that we have to really pay attention to whether the Fed is going to be able to pull off the fabled soft landing. I think that it's possible. It's possible if we see unemployment still remain low, but as we've talked about, once that starts going up, look out. It's possible that the economy just hasn't experienced the full effect of the rise in rates that the Fed has done, because there is a lag effect there. And there could be geopolitical flare-ups, right? I mean, constant issues with China that we're having in terms of trade, in terms of military, in terms of Taiwan, that obviously could be a negative for the markets. So again, we do feel that a little more defense makes sense after such a great start to the year. And so I did mention some of the things we're doing, being a little more overweight the consumer defensive sector, rebalancing, taking a bit off the table from some of the tech stocks that have done so well. And of course, we're always happy to invest in companies that we think are going to be leaders and that will remain leaders for some time to come, irrespective of the markets right now. So with that, I will take a pause, and hopefully that was informative. And any questions out there, Anna?
If you all have any questions, please submit them now through the Q&A feature. We'll give folks just a second to get their questions submitted. One that we have is on the real estate market. That's kind of a hot topic for folks as we see interest rates continuing to climb. What do you think has to happen to see some relief with those interest rates, or do you think this is the new normal?
So I think one of the reasons that the real estate market is so interesting is because it has to do with the statistics that a huge majority of homeowners actually have mortgage rates that are pretty low. I mean, I think something around 50 to 60% of homeowners have mortgage rates that are below 4%. So if you have a mortgage that's below 4%, you're not going to sell because what happens if you sell? Well, usually you got to buy something else. And right now, if you buy something else, your mortgage rate is going to be well over 6%. And so that's not really attractive to a lot of homeowners. So what that has done is it has really constrained housing inventory. So it's still really hard to buy a house because there's such low inventory. And that has been why the housing market's in an interesting dynamic, because usually when interest rates rise, you really should see the housing market soften a bit. And usually the softening stimulates more buying activity, but that has really yet to be the case. So that is one of the reasons why the housing market remains kind of stuck where it is and isn't probably going to change anytime soon. Again, because if you are a homeowner that locked down one of those great low mortgage rates, good for you, because that actually hedged you against the rising rate environment that we're seeing today. And that hedge is going to last for as long as you hold that mortgage. So that's been an interesting dynamic we've seen. And I know we've gotten a lot of questions about real estate. So, you know, we'll see how that plays out. I do think that if rates come down a bit, the housing market hopefully would loosen up in terms of the more inventory. And obviously home builder stocks have done really well this year because they're trying to make up for a lack of inventory that's been a problem for many years. But even that's not happening fast enough.
Great, thank you. I think that's all the questions that we have for today. So after the webinar, you'll see a survey. Please complete that survey and let us know what you think. Let us know what you'd like to hear about in the future. We're very interested in hearing your feedback. So Steve, I'll let you close us out.
Well, thank you, everyone. Thanks for your attention. Hopefully it was informative. Please send us your feedback. Always happy to hear it. And until next time, and happy to answer any questions offline if anyone has any.
Thank you, everyone, for joining us.